Today we're diving deep into VFMF, the Vanguard US Multi-Factor ETF. It's a popular option for investors, but is it all it's cracked up to be? We'll be cracking the code on VFMF's strategy, comparing it to building your own portfolio, and seeing if it can really outperform the market. VFMF promises a multi-factor approach, mixing value, momentum, and quality factors to find hidden gems. But is it actively managed magic, or just a mystery box of risks and rewards? We'll break down the fees, the rebalancing strategy, and how VFMF stacks up against good old-fashioned stock picking. So buckle up, ETF enthusiasts, because in the next few minutes, we're gonna chat VFMF from top to bottom. Hit that like button and let's get chatting. What is VFMF ETF? VFMF, ticker symbol for the Vanguard US Multi-Factor ETF, is an exchange-traded fund, ETF, designed to provide long-term capital appreciation by investing in US stocks that exhibit specific characteristics. Here's a breakdown of what VFMF offers. Investment strategy. Multi-factor approach. VFMF takes a unique approach by targeting companies based on a combination of three factors: value, momentum, and quality, along with an initial volatility screen. Value seeks companies trading at a discount to their perceived intrinsic value. Momentum targets companies experiencing strong upward price trends. Quality focuses on companies with strong financial health, profitability, and management. Volatility screen aims to reduce overall portfolio risk by excluding excessively volatile stocks. Benefits. Diversification. By incorporating these factors, VFMF aims to capture potential returns from different market segments and reduce reliance on the performance of any single factor. Actively managed. Unlike many broad market ETFs that passively track an index, VFMF is actively managed by Vanguard. This means a team of investment professionals selects and weights holdings based on their analysis. Potentially higher returns. The multi-factor approach seeks to outperform the broader market by capturing returns from undervalued, growing, and financially sound companies. What is the primary objective of the VFMF ETF? Does it align with my overall investment goals? The primary objective of the VFMF ETF is to achieve long-term capital appreciation by investing in U.S. stocks with specific characteristics. This means the fund prioritizes growing the overall value of your investment over time, primarily through share price appreciation. Here's a deeper look to see if it aligns with your goals. Factors to consider. 1. Your investment goals. Growth. If your primary goal is to grow your wealth over the long term, and you're comfortable with some risk, then VFMF could be a good fit. The multi-factor approach targets companies with growth potential, through momentum factor, while also considering value and quality. Income. VFMF may not be the best choice if your primary goal is to generate current income. While some holdings may pay dividends, the focus is on capital appreciation, and dividend yields may be lower compared to income-oriented ETFs. Preservation of capital. If your main concern is protecting your principal investment, VFMF might not be the most suitable option. Stock markets are inherently volatile, and while the multi-factor approach aims to mitigate risk, there's no guarantee against losses. 2. Investment time horizon. VFMF is designed for long-term investors. The multi-factor strategy targets companies with growth potential, which typically requires a longer investment timeframe, 5+ years, to ride out market fluctuations and potentially achieve capital appreciation. If you need access to your money in the short term, less than 3 years, VFMF might expose you to too much risk of short-term market volatility. Is VFMF actively or passively managed? How does the manager select and weight holdings within the ETF? VFMF is an actively managed ETF. This means unlike passively managed index ETFs that simply track a market index, VFMF has a dedicated team of investment professionals at Vanguard who actively select and weight the holdings within the ETF. Here's a breakdown of how the VFMF managers make their choices. Active management approach. 1. Multi-factor strategy. The core principle involves selecting companies based on a combination of 4 factors. Value. The managers identify companies trading at a discount to their perceived intrinsic value, potentially offering higher returns in the long run. Momentum. They target companies experiencing strong upward price trends, aiming to capitalize on continued growth. Quality. The focus is on companies with robust financial health, profitability, and strong management, aiming for stability and long-term sustainability. Volatility screen. An initial layer of risk management involves excluding excessively volatile stocks, aiming to reduce overall portfolio risk. 2. Security selection. The managers utilize a quantitative screening process to identify companies exhibiting these desired characteristics across the U.S. equity market. They likely employ sophisticated financial models and data analysis tools to assess company fundamentals, valuations, and historical price movements. 3. Weighting decisions. Once the candidate pool is established, the managers determine the weight, percentage of the total portfolio, each security will hold within VFMF. Weighting might be based on a combination of factors like the company's relative strength within each factor, value, momentum, quality, overall portfolio diversification needs, and the manager's judgment regarding future growth potential. Benefits of active management. Targeted exposure. The multi-factor approach allows VFMF to target specific segments of the market that have historically outperformed, potentially leading to higher returns compared to a broad market index. Flexibility. The managers have the ability to adapt the portfolio based on changing market conditions and economic factors. They can adjust weights or even remove holdings that no longer meet their criteria. What are the total expense ratios associated with investing in VFMF? How does this compare to similar ETFs? The total expense ratio, TER, associated with investing in VFMF is 0.18% as of March 27, 2024, according to sources like Vanguard and ETF Database. This TER represents the annual fees you'll pay as a percentage of your total investment in VFMF. Here's a breakdown of how it compares to similar ETFs. VFMF expense ratio in context. Relative to Vanguard ETFs, Vanguard is known for its low-cost ETFs. The average expense ratio for all Vanguard ETFs is around 0.05% as of December 31, 2022. So, VFMF's TER is higher than the Vanguard average due to its actively managed nature. Compared to actively managed multi-factor ETFs, while a direct comparison is difficult due to variations in specific factor combinations and fees, actively managed multi-factor ETFs typically have TERs ranging from 0.30% to 0.70%. In this context, VFMF's 0.18% TER falls on the lower end of the range for actively managed multi-factor options. Relative to passively managed broad market ETFs, passively managed ETFs that track broad market indexes like the SP 500 typically have much lower TERs, often below 0.1%. This is because they require minimal ongoing management. Understanding TER impact. The TER directly affects your investment returns. A lower TER means a higher portion of your returns are retained, while a higher TER eats into your profits. For example, if you invest $10,000 in VFMF and it generates a 10% annual return, the TER of 0.18% would result in a fee of $18. This leaves you with a net return of 9.82%. How does the risk profile of VFMF compare to other asset classes or investment options? VFMF, the Vanguard U.S. Multi-Factor ETF, carries a risk profile that falls somewhere between actively managed mutual funds and passively managed broad market ETFs. Here's a breakdown of how it compares to other options. VFMF risk profile. Higher risk than broad market ETFs, VFMF is inherently riskier than passively managed broad market ETFs like the SP 500 ETF, SPY. This is because actively managed, VFMF is actively managed, meaning it deviates from a specific index and attempts to outperform the market. This introduces the risk of underperformance if the manager's selections don't deliver as expected. Multi-factor strategy. While the multi-factor approach aims to capture returns from different market segments and potentially mitigate risk, it still exposes you to the volatility of the underlying stocks within the ETF. Lower risk than individual stock picking, VFMF offers diversification by holding a basket of stocks. This reduces risk compared to picking individual stocks, where the performance of a single company can significantly impact your overall investment. Potentially lower risk than some actively managed mutual funds. The expense ratio of VFMF is typically lower than actively managed mutual funds targeting similar strategies. Lower fees can translate to potentially higher returns, reducing overall risk-adjusted performance. Factors affecting risk profile. Market volatility. Like any stock investment, VFMF is susceptible to fluctuations in the overall stock market. During economic downturns or market corrections, the value of VFMF can decline. Underlying holdings. The specific companies held within VFMF and their industry weightings can also impact the risk profile. A higher concentration in volatile sectors like technology or cyclical industries might increase the overall risk. Investment time horizon. The longer you hold VFMF, the more time you have to weather market fluctuations and potentially achieve your investment goals. Short-term investors are more exposed to short-term price swings. Risk comparison with other asset classes. Lower risk than emerging markets. Emerging market stocks generally carry higher risk due to factors like political instability and currency fluctuations. Similar risk to developed international stocks. Developed international markets like Europe or Japan might offer similar risk profiles to VFMF, though specific country exposures can vary. Lower risk than commodities. Commodities like oil or gold can be highly volatile, making them riskier than VFMF in most cases. Lower risk than real estate. Direct real estate investment typically involves higher upfront costs, illiquidity, difficulty selling quickly, and management responsibilities, making it a potentially riskier option for some investors. Lower risk than venture capital/private equity. Venture capital and private equity investments are generally illiquid and involve a high degree of risk, targeting high-growth startups with uncertain outcomes. They are typically suitable for sophisticated investors with a long investment horizon and high risk tolerance. How sensitive is VFMF to fluctuations in the overall stock market? VFMF, the Vanguard U.S. Multi-Factor ETF, is moderately sensitive to fluctuations in the overall stock market. While the multi-factor strategy aims to mitigate risk and potentially outperform the market, it's still susceptible to broad market movements. Here's a breakdown of the factors at play. Sensitivity to market fluctuations. Equity exposure. VFMF invests entirely in U.S. stocks. Stocks are inherently sensitive to market movements. When the overall market goes up, VFMF's value is likely to rise as well. Conversely, during market downturns, VFMF's price can experience significant declines. Active management. The multi-factor approach attempts to outperform the market by selecting companies based on value, momentum, and quality factors. However, this selection process doesn't eliminate market risk entirely. If the chosen factors underperform during a broad market correction, VFMF might not be fully insulated. Mitigating risk factors. Diversification. VFMF holds a basket of U.S. stocks across various sectors and industries. This diversification helps spread risk and reduces the impact of a single company's performance on the overall ETF. Quality factor. The focus on quality within the multi-factor strategy aims to select companies with strong financials and profitability. In theory, these companies might be more resilient during economic slowdowns, potentially reducing the downside risk for VFMF compared to a purely market cap-weighted ETF. Understanding sensitivity levels. Compared to broad market ETFs, VFMF might be slightly less sensitive to market fluctuations than a pure market cap-weighted ETF, like the SP 500, SPY, due to its focus on value, momentum, and quality factors. However, the difference might be negligible during severe market corrections. More sensitive than fixed income, VFMF is significantly more sensitive to market fluctuations than fixed income investments like bonds. Bonds generally offer more predictable returns, with lower volatility. Factors affecting sensitivity. Market volatility. During periods of high market volatility, VFMF's sensitivity to market movements will be more pronounced. The price swings in the underlying stocks can be amplified, leading to larger fluctuations in the ETF's value. Underlying holdings. The specific companies within VFMF and their industry weightings can also impact sensitivity. A higher concentration in cyclical sectors like financials or materials might increase the sensitivity to economic cycles. Does VFMF have a value or growth tilt in its holdings selection? VFMF, the Vanguard U.S. Multi-Factor ETF, incorporates a multi-factor approach that combines elements of both value and growth investing. Here's a breakdown of how it works and the potential implications. Multi-factor approach and holding selection. Value factor. VFMF actively seeks companies trading at a discount to their perceived intrinsic value. This suggests a tilt towards value stocks with the potential for future price appreciation as their value is recognized by the market. Momentum factor. The strategy also considers companies experiencing strong upward price trends, potentially indicating growth potential. This inclusion of momentum characteristics adds a growth element to the mix. Balancing value and growth. The target weightings for each factor can vary within VFMF. Vanguard doesn't publicly disclose the exact allocation, but it likely aims for a balance between value and growth to capture returns from both ends of the spectrum. Historically, VFMF has exhibited a slight value tilt in its holdings. This means the value factor might have a slightly higher weighting compared to the momentum factor within the portfolio. However, the specific weightings can change over time based on market conditions and the investment team's analysis. Benefits of a multi-factor approach. Potential for higher returns. Combining value and growth characteristics allows VFMF to capture returns from undervalued companies with potential for future growth, value, and from companies already experiencing strong upward momentum, growth. How does VFMF compare to actively managed funds that invest in similar asset classes? Can actively managed funds outperform the market over the long term? VFMF, the Vanguard U.S. Multi-Factor ETF, falls under the category of actively managed funds that invest in U.S. equities. Here's a breakdown of how it compares to other actively managed funds targeting similar asset classes. Similarities. Active management. Both VFMF and other actively managed funds employ a dedicated team of investment professionals who research, select, and weight holdings based on their investment philosophy and market analysis. Potential for outperformance. Both aim to outperform the market by identifying undervalued or high-growth opportunities that passively managed index funds might miss. Higher fees. Actively managed funds, including VFMF, typically have higher expense ratios compared to passively managed index funds due to the costs associated with research, management, and portfolio turnover. Differences. Investment strategy. VFMF utilizes a multi-factor approach, focusing on value, momentum, and quality factors. Other actively managed funds might employ various strategies like growth investing, value investing, deep value investing, or sector rotation. Transparency. VFMF holdings are publicly disclosed, while some actively managed funds might not disclose their entire portfolio due to proprietary strategies. Fees. While VFMF's expense ratio falls on the lower end within the actively managed multi-factor category, around 0.18% as of March 27, 2024, other actively managed funds can have significantly higher expense ratios depending on the complexity of their strategy and management team. Can actively managed funds outperform the market? Outperformance is challenging. Extensive research suggests that consistently outperforming the market over the long term is difficult for actively managed funds. Market efficiency and competition make it challenging to consistently identify undervalued or high-growth opportunities. Fees are a drag. The higher expense ratios of actively managed funds eat into potential returns. To outperform the market after fees, the fund needs to generate a return that surpasses both the market benchmark and its own expense ratio. VFMF's potential advantage. Lower cost. Compared to other actively managed multi-factor funds, VFMF's expense ratio is relatively low. This potentially gives it a better chance of overcoming fees and delivering competitive returns. Are there any mutual funds that offer similar investment objectives and strategies as VFMF? How do the expense ratios and investment minimums compare? Yes, several actively managed mutual funds offer investment objectives and strategies similar to VFMF, Vanguard US Multi-Factor ETF. Here's a breakdown for comparison. Similar mutual funds to VFMF. Fidelity Multi-Factor U.S. Equity Fund, FMUS. This mutual fund from Fidelity employs a multi-factor approach focusing on value, quality, and momentum factors similar to VFMF. It invests in U.S. companies across the market capitalization spectrum. T. Rowe Price U.S. Equity Factor Model Portfolio, PRGTX. This T. Rowe Price offering utilizes a quantitative model to select U.S. stocks based on a combination of factors like value, momentum, quality, and profitability. Schwab U.S. Multi-Factor Large Cap ETF, SCHE. While technically an ETF, it functions similarly to a mutual fund and offers exposure to U.S. large cap stocks selected based on a multi-factor approach, value, quality, momentum. Expense ratio comparison. VFMF, expense ratio around 0.18% as of March 27, 2024. FMUS, expense ratio around 0.63%. PRGTX, expense ratio around 0.75%. SCHE, expense ratio around 0.18%, similar to VFMF. Investment minimum comparison. VFMF, typically, you can purchase shares of VFMF with any amount of money through most brokerage platforms because it's an ETF. Shares are priced like a stock, and fractional shares are often allowed. FMUS, the investment minimum for FMUS can vary depending on the brokerage platform you use, but it's often around $2,500. PRGTX, the investment minimum for PRGTX can also vary by broker, but it's typically around $2,500. SCHE, similar to VFMF, SCHE functions like an ETF and typically has no minimum investment requirement. You can purchase fractional shares with most brokers. Key points to consider. Expense ratio. VFMF has a significant expense ratio advantage compared to the actively managed mutual funds, FMUS and PRGTX. This lower cost could potentially translate to higher returns over time. Investment minimum. VFMF and SCHE offer greater accessibility due to their lack of minimum investment requirements. This is particularly beneficial for investors starting with smaller amounts. Management style. While all these options utilize a multi-factor approach, the specific factors and weighting methodologies might differ. How does investing in VFMF compare to building a diversified portfolio of individual stocks myself? Here's a breakdown of the pros and cons of investing in VFMF, Vanguard US Multi-Factor ETF, compared to building your own diversified portfolio of individual stocks. Investing in VFMF. Pros. Diversification. VFMF holds a basket of U.S. stocks across various sectors and industries, providing instant diversification and reducing your reliance on the performance of any single company. Low cost. VFMF has a relatively low expense ratio compared to actively managed mutual funds. Lower fees can translate to potentially higher returns over time. Convenience. VFMF is easy to buy and sell through most brokerage platforms. You don't need to spend time researching individual companies. Professional management. The ETF is actively managed by a team of investment professionals who research and select holdings based on their multi-factor approach. Cons. Less control. You don't have direct control over the specific companies held within VFMF. The investment decisions are made by the ETF managers. Limited customization. The multi-factor approach might not perfectly align with your individual investment goals or risk tolerance. Market dependence. VFMF's performance is still tied to the overall stock market. It can experience losses during market downturns. Building a diversified portfolio of individual stocks. Pros. Customization. You have complete control over which stocks you invest in, allowing you to tailor your portfolio to your specific investment goals and risk tolerance. Potentially higher returns. By carefully selecting high-growth stocks, you might achieve higher returns than a passively managed ETF like VFMF. However, this is not guaranteed and requires significant research and expertise. Direct company exposure. You can invest in companies you believe in and are passionate about. Cons. Time commitment. Building a diversified portfolio requires significant research and analysis of individual companies. You need to stay informed about their financial health, industry trends, and overall market conditions. Higher risk. Individual stocks can be more volatile than diversified ETFs. A poorly chosen stock could significantly impact your portfolio's performance. Emotional investing. The temptation to make emotional decisions based on market noise or personal bias can be higher when managing your own portfolio. Here are some additional factors to consider. Investment knowledge and experience. If you're a new investor with limited knowledge of stock analysis, VFMF might be a safer and more convenient option. Risk tolerance. If you have a low risk tolerance, VFMF's diversification can help mitigate risk. However, you might explore combining VFMF with other asset classes like bonds for further risk reduction. Time availability. Building and managing a diversified portfolio requires ongoing research and monitoring. If you don't have the time to dedicate to stock analysis, VFMF offers a more passive approach. Are there any sector-specific ETFs that can be considered as an alternative to the broad market exposure offered by VFMF? Yes, there are many sector-specific ETFs that can be considered as an alternative to the broad market exposure offered by VFMF, Vanguard US Multi-Factor ETF. Here are some examples. Technology sector ETFs. these ETFs focus on companies in the technology sector, which can be a high-growth area, but also more volatile. Some popular technology sector ETFs include SPDR-SP Semiconductor ETF, XSD. This ETF tracks the performance of the SP Semiconductor Industry Index, which includes leading companies in the semiconductor industry. Invesco QQQ Trust, QQQ. This ETF tracks the Nasdaq 100 Index, which includes 100 of the largest non-financial companies listed on the Nasdaq Stock Exchange. Many of these companies are technology companies. Healthcare sector ETFs. These ETFs focus on companies in the healthcare sector, which can be a relatively defensive sector that offers steady growth. Some popular healthcare sector ETFs include Healthcare Select Sector SPDR Fund, XLV. This ETF tracks the Healthcare Select Sector Index, which includes companies in the pharmaceutical, biotechnology, and medical device industries. Vanguard Healthcare ETF, VHLT. This ETF tracks a broad index of U.S. healthcare companies. Financial sector ETFs. These ETFs focus on companies in the financial sector, such as banks, insurance companies, and asset management firms. The financial sector can be cyclical, meaning that its performance can be tied to the overall economy. Some popular financial sector ETFs include Financial Select Sector SPDR Fund, XLF. This ETF tracks the Financial Select Sector Index, which includes a variety of financial companies. Consumer Staples Sector ETFs. These ETFs focus on companies that sell consumer staples, such as food, beverages, and household goods. Consumer staples companies tend to be less volatile than companies in other sectors, as people always need to buy these products regardless of the economic climate. Some popular consumer staples sector ETFs include Consumer Staples Select Sector SPDR Fund, XLP. This ETF tracks the Consumer Staples Select Sector Index, which includes companies in the food, beverage, and household products industries. These are just a few examples of the many sector-specific ETFs that are available. When considering a sector-specific ETF as an alternative to VFMF, it is important to carefully consider your investment goals and risk tolerance. Sector-specific ETFs can be more volatile than broad market ETFs, so they may not be suitable for all investors. Here are some additional factors to consider when choosing a sector-specific ETF. The weight of the sector in the ETF. Some sector-specific ETFs focus on a narrow range of companies within a sector, while others invest in a broader range of companies. The expense ratio of the ETF. The expense ratio is the annual fee that you pay to own the ETF. Lower expense ratios are generally better. The investment objective of the ETF. Some sector-specific ETFs are designed to track a particular index, while others are actively managed by a portfolio manager. That's all the time we have for VFMF today. So, the verdict? VFMF offers a convenient, diversified way to access the U.S. market with a multi-factor twist. It comes with lower fees than some actively managed funds, but the lack of a set rebalancing schedule might leave some investors wanting more transparency. Ultimately, the decision depends on you. If you're a new investor or prefer a hands-off approach, VFMF could be a solid choice. But if you crave customization and enjoy researching individual stocks, building your own portfolio might be the way to go. No matter which path you choose, remember, knowledge is power. Do your research, understand the risks and rewards, and don't hesitate to consult a financial advisor for personalized guidance. Thanks for joining the chat today. Leave a comment below and let us know your thoughts on VFMF. What are your favorite ETFs or investing strategies? We love hearing from you. Hit that subscribe button for more ETF breakdowns and investment insights, and we'll see you on the next episode of Chat ETF.